Bismillahirrahmanirrahim. Assalamu alaikum everyone. My name is Yasir Yamin and I welcome you all in today's session. Guys, just like our previous class, in today's class, we are going to discuss investors' perspective again. Now remember when SBR was actually launched, examiner was of the point of view that investors' perspective is the, core of this paper. Before SBR, there used to be a paper which was known as P2, Professional Level 2. I mean, it was the second paper in professional series. And then your qualification, ACCI, transformed that particular P2 paper into SBR. And while they were launching SBR, everybody from ACCI, their headquarters, everybody used to tell us that, see, we are transforming this P2 paper into a paper which not only examines your number crunching, not only examines how good you are with particular IS or IFRS, but you also need to have that perspective that why we do what we do. I mean, why you when we follow a particular IS or IFRS, how does it actually help your investor? I was referring to in our last class, I was referring to why sustainability reporting was important, because investors nowadays make their decision considering sustainability factor as well. So they need some sustainability related information and complete information so that they can rely on that information and make their decisions. They can make decisions how much to allocate resources to a particular company, right? Likewise, whenever you follow a particular accounting standard, investors get knowledge out of it. I'm not saying that every accounting standard is complete. It shows very good information for investor, but most of the time, there are more advantages of following a particular accounting standard from the investor's perspective rather than not disclosing or not providing a particular type of information, right? So often your examiner, gives you a certain part in your entire examination for like it can be of 8 marks, 10 marks, 12 marks, 7 marks, whatever. An examiner asks you, gives you a particular type of scenario and asks you to comment from the investor's perspective why providing an information according to any particular accounting standard, why would this be essential to an investor? How would this information, help your investor in making his or her decisions? So that's investor's perspective. And remember, your even your Kaplan examination kit always comments on this point that whenever investor's perspective is examined, it's always easy marks for the student. It's always easy marks for the student. Now it's up to the student to gain those marks, right? So from that mindset, let's do a particular question from your examination kit. And again, we are going to challenge ourselves with a new question, with a new requirement, and see how to develop an answer over it, right? So before we even begin, I would want you to have a fresh mind in place, right? Do not be, of the opinion that, okay, I mean, let's say you read this question and you see somewhere written provisions, and there you go, IS 37. Okay, IS 30, we will create a provision, we do this, we do this, we do this. Whenever you get an investor's perspective question, it's not about what you are going to do. It's all about what you have already done in your financial statements. Would you rate that information, being useful or not for your investor? So, partially switch off your accounting, your core accountant's view and have an investor's perspective against that. And then let's do this question. So we are only doing a part of this question, Mehran. It says that Mehran has recognized provisions in its financial statements for the year ended 31st March 20x6. So the accounting year end is 31st March 20x6. And it seems that Mehran has recognized some provisions in its financial statements. Examiner says it has produced the following provisions disclosure note. So please note this point. A disclosure is being provided for provisions. There were some provisions in your current liabilities and non-current liabilities. And Mehran thought to provide a separate disclosure. Mehran thought to provide a separate disclosure on this provision. Now, my question to you is, again, having that investor's perspective, a general question. Why do you think providing a disclosure for provision, why or how will it help your investor? I mean, should we be providing a disclosure to explain the provision, or should we not be providing a disclosure to explain the provision? I mean, the absence of a disclosure note, would that have been sufficient? Shouldn't we have avoided all the fuss and decided, okay, we are not going to provide any disclosure? What do you suggest? I mean, use your common sense about it. Would you want to provide a disclosure to your investor? Yes or no? No. Whenever there is silence, it means no. Oh, yes. You would want to provide a disclosure to your investor so that it improves the understandability of your investor, right? Your investor would be able to understand the nature of the obligation, right? How else would your investor understand? Let's say in your current liability, you just had written provision for refund. How would your investor react to this? Your investor would see a liability in financial statements that says this is a provision for refund. Now, he would assume that there was some money which was taken by the company and now they need to refund that amount. But why? Is this normal practice or is this special practice? You know, questions like these would arise into your investor's mind. Wouldn't it be much better if we improve the understandability of your investor so that he could understand the nature of the obligation and other information about this provision? Why don't we provide a disclosure? So providing certain information always helps your investor to understand, the rationale behind numbers in your financial statements. Now, following are the disclosure notes. Your total provision is 18.2 million. All right. So when we see in total, our total provision is 18.2 million. And this was at 1st April 20x5. And our total provisions are 22.8 million at 31st March 20x6. So technically speaking, our provisions have increased. That means companies' liabilities are increasing. Now, this might cause a concern for your investors. But this disclosure actually provides additional information to your investors so that he understands what is there in your liabilities, what is there in your provisions. So there is a breakup given of provisions. Now, there are two types of provisions available to the company. One relates to customer refunds, and the other one relates to reorganizations. So, customer refunds, a provision for customer refund. You might have heard about this even when we were studying IFRS 15. Let's say I'll make a hypothetical scenario. Let's say Mehran sells their product to some distributors on an arrangement that they have a right to return. Or if any other item is actually not sold to the eventual customer, they can, return any unsold material to Mehran. Now, you are doing a business in which it is possible that some portion of the goods that you have transferred to the customer, may come back to you and you would have to refund your customer. It's just like, running Amazon. It's just like running Daraz. It's just like running any other business, right? So what you do is you create a provision against that refund. You create a provision against that refund. Now if you closely analyze what's happening, on 1st April 20x5 your refund was 10.2 million. So at the start of the year, it was estimated, remember, a provision is a liability of uncertain timings or amount. So it's just an estimate. At the start of the year, the company estimated that during the following year, at least $10.2 million worth of refunds would be claimed. And what happened actually? You see, there is a word given here, utilized. It says utilized were 9.1. So we estimated that there are going to be refunds amounting to 10.1. People are going to claim back their money, but the actual refunds that happened were 9.1. This means our estimate was not accurate. Do you all agree? Agree? Our estimate was not accurate, right? And rightly so. It all depends on judgment. There can be under or over provisions always. And it also suggests that maybe next time we can create a lesser provision as a percentage of sales. Make sense? Make sense? This year, we create another provision which is charged to profit or loss. It is 13.1 million, and hence our closing balance assumes to be as 14.2 million. Make sense? So all in all, you can see the provision for customer refund in absolute terms is higher than previous year. But it would have been much better. I mean, you would also suggest this. It would have been much better if there was some additional information given into the disclosure note, or maybe your investor can calculate by himself what would be the provision as a percentage of sales. As a percentage of sales. Maybe in absolute terms, you would say that the provision for customer refunds is increasing, but maybe as a percentage of sales, it's even lesser in percentage terms. Make sense? So all of this information is inferred from the disclosure note provided. We haven't read anything extra. Just by looking at the numbers, this is the logic, or this is the understanding that comes into our mind. So definitely this disclosure is useful. Then your examiner provides you some sort of uh, breakup of this 14.2 million. Out of this 14.2 million, 14.2 million is the current liability, whereas there is no non-current liability. What do you mean by that? You have a provision of 14.2 million, and all of that 14.2 million has to be shown under current liability. So what does this infer? What does this mean? You see, classification of liability and bifurcation of that liability into current and non-current provides your investors the information about the expected outflow of benefits and its timings. Do you understand this point? It's very important to classify your provisions or your liabilities into current or non-current. You can clearly see that by reading this classification, your investor would understand that this 14.2 million of an outflow of economic benefit is expected to occur in next year. So while he is appraising your financial statements, or while he is expecting what is going to happen in next year, while he's deciding on whether to purchase the share or not, he knows now that 14.2 million will incur next year, right? Current liability is any liability against which outflow is expected or settlement is expected within 1 year of the reporting date. All right. On the contrary, if you see the next part, which is reorganization provision, here you can see that the total ending balance of the provision is 8.6 million, out of which 8 million is current liability, whereas 0.6 million remaining balance is non-current liability. Here, your investor would understand that the major outflow is expected to happen next year, but even after that, your life will not be spared. You can expect additional amount of cash flows to cash outflows to occur in years to come, and this can be after 1 more year or 2 more years or 3 more years and so on and so forth. So at least the timing of outflows your investor can expect through these disclosures. As we assessed the customer refund provisions, we can assess the same. At the start of the year, we expected some reorganization provisions, and these amounted to $8 million. The actual utilized was 9.6 million. So in customer refunds, we expected a bit higher than what actually arose. In reorganizations, we expected a little less as compared to what actually arose. All right. So against 8 million, we had a provision of 9.6 million. We are charging another provision. We are charging another provision of 10.2 million on the expected cost of reorganizations. And, this is much higher as compared to last year. Just imagine if I were to draw an SOFP, and just imagine if no disclosures was given, no disclosures were given, and I just drew an SOFP, and in my current or non-current liabilities, I just showed provisions amounting to 22.2 million, 22.8 million. How will your investors get to know about this fact that this year the provisions are higher than previous year? How will they know that what is going to be the timing of the cash outflow? Just by looking at the balance sheet without any disclosures, your investors cannot infer the correct analysis. Your investors can never come to the right conclusion. And that is why providing a detailed disclosure of the provision will help your investor understand the nature of the obligation, the timing of outflow, the settlement pattern, the judgments, the assumptions made. Everything your investor will be able to understand when he sees the disclosure. So providing a disclosure for provisions is very important. If we move forward, examiner says provisions for customer refunds reflect the company's expected liability for return of goods sold in retail stores based on experience of rates of return. So customer refunds basically relate to the expectation based on past practices that how much we will have to refund to the customer, and this whole judgment is based on past practices. Now, this judgment, this criteria for judgment must also be disclosed. This will help your investor understand how you have come to the conclusion that your closing liability should be 14.2, let's say. Right? Then provisions for reorganizations reflect restructuring and redundancy costs, principally in relation to our retail operations as well as restructurings in finance and IT. Now, do you think they providing separate information about provision for reorganizations would help your investors understand the state of affairs of your business? I think yes. Just imagine, let's say I'm running a business right now. Okay. So Subrat comes and says, okay, sir, I'm going to invest, let's say, 2 crore rupees into your business. And I say, okay, fine. And each year I'm going to provide you my income statement, balance sheet. You can review it if you want. Each year I'll be, providing you some dividend and you should be happy about it, right? So he invests 2 crore rupees into my business, right? And then when he sees my balance sheet, there seems to be a provision liability of, let's say, 22.8 million, which is, approximately more than 2 crore rupees. So he asked me, sir, what's the scene? There is a liability that I see in your books of 22.8 million. What's the scene? And I tell him nothing. Would he be comfortable with my answer? I mean, if you're not providing a disclosure to your investor, you are literally saying to your investor, I can't tell you anything. Would that help Subrat, deciding whether he wants to continue his investment into my business or not? I don't think so. But when he sees that, okay, Sir Yasir has created a provision which relates to reorganization, and he is saying that this reorganization is relating to restructuring and redundancy. And principally, what we are trying to do, we are going to revamp our retail operations. Maybe there is a downfall in sales. Maybe there is something going bad into our retail. Maybe there is, maybe there has been some theft of inventory, maybe there has been some fire or something, and that is why we need to further strengthen our finance and retail operations. And when I explain you this, that we are reorganizing our retail store channel, so that every payment is on bank, nothing is taken for cash, the cash does not get stolen, inventory is secure, and that is why I'm investing in finance and IT. Would you be more happier now? Definitely think yourself, consider yourself an investor. If you listen to me through my financial statement disclosures that I'm going to restructure my business, I'm going to reorganize my business, I'm going to further spend on finance and IT into my retail stores just to revamp the whole business, don't you think you will be more satisfied while receiving this information from me rather than just watching this provision 22.8 million as a total? Give me your feedback, right? So, your examiner always provides for this in his examiner comments, and he always says that whenever you get a question which is related to investor's perspective, just for a while think yourself as an investor and think, would you want to see this information about a particular business or not? And there you will have an answer and you'll start writing your answer on it, right? So it says that the directors of Mehran have been asked by an investor to explain the accounting for provisions. First question from you, Abduram. Can you explain the accounting for provisions to me? I mean, this is going to be an 8-mark requirement. So some marks, maybe 2, 3 marks are going to be for explanation of the accounting for provisions. Can you explain the accounting for provisions? I mean, which accounting standard do you refer if you want to explain the accounting for provisions? Oh, yes, IS 37. So I think we are going to start our answer just by referring to IS 37. According to IS 37, a provision is a liability of uncertain timings or amount. A provision can only be recognized when three of the following conditions are met. There must be a present obligation arising as a result of past events. That present obligation can be established, based on law, or it can be a constructive obligation. A constructive obligation is an obligation which is established on an entity due to its past practices or published policies. Then there must be probable chances of outflow, and then there must be a reliable estimate. An entity should recognize a provision, where single-ended, as far as single-ended outcomes are concerned, the entity should be recognizing a provision based on management's best estimate. Otherwise, if there are multiple ended scenarios or there can be multiple outcomes to a particular scenario, then a weighted average provision can be recognized, or a provision can be recognized on an expected value basis. I mean, all of this you tell just for 2 through 3 marks. Literally, these are easy marks. So the directors of Mehran has been asked by an investor to explain the accounting treatment for provisions in the financial statements and to explain why the information provided in the provisions disclosures note is useful. As far as the requirement is concerned, explain to the investor the nature of accounting for provisions. As far as the nature of accounting for provisions is concerned, you just write whatever is written under IS 37. And I hope you remember this. Make sense? Then your answer should explain the benefits and limitations provided in Mehran's disclosure note. Now you need to come up with an answer. Why do you think investor is going to be much more satisfied and feel more confident when he sees this disclosure as opposed to not providing a disclosure, right? So just you need to make your own answer. And believe you me, whatever answer you write, it's going to be correct, right? So it's not about right or wrong. It's not about as per IS 37. The second part of the question only wants you to explain the information which has been provided by Mehran. Do you think it's going to be useful or not? Do you think it's going to be beneficial, or it has some limitations as far as Mehran is concerned? So whatever you feel is right, you write. And when you write, you'll get marks. Make sense? So these are kind of questions that give you easy marks, not difficult marks. I tell you that if you are in an exam, and let's say you are only left with 15 or 20 minutes, and you still have to attempt, like if you have 15 or 16 marks remain. I'm just creating a hypothetical scenario. Let's say you are into your exam, you have 15 minutes to go, and you have 16 marks remaining in your question paper to be attempted. And let's say these 16 marks pertain to 8 marks requirement, of question 2 or 3, and 8 marks, such a requirement, from an investor's perspective. I would recommend that you go and attempt investor's perspective part, because any answer that you write is going to give you very good marks. You understand my point? These are going to give you very good marks. Abdurrahman is asking, sir, marks allocation is not written here. Yes, I can see that. It's not written here. Yes, it's not written here. I cannot invent it, right? So that's irrelevant, right? So I would suggest that go for such type of a question, right? You can assume that 2 marks here and 5 marks there, or 6 marks there, whatever you can assume regarding the marks allocation. It's, nowadays when examination question comes, your examiner tries to allocate the marks within the requirement. But since this is an old past paper, not a very old past paper, but a decently old past paper, marks allocation, Abdurrab, is not given in the requirement itself. So I don't want to invent it, right? Now, I think that you have read the question with me perfectly. Now let's go through your examiner's answer. Let's go through the answer of your examination kit. And let's see, where does our understanding actually lacks, or do we fulfill the answer, or do we come up to the criterion which is established by your examination kit? Let's see. So first of all, if you see the tutorial note which is given by your examination kit, it clearly says that this question requires you to explain the accounting treatment for provisions, and this should be a source of easy marks. So if this is a source of easy marks, why would you leave it? Right? Then your examiner, even your examination kit, starts to answer this question by answering the first part. Explain to the investor the nature of accounting for provisions in financial statements. Your examination kit starts by explaining how provisions are to be accounted for under IS 37. And from here till the end, everything is IS 37. Everything we usually discuss about IS 37, they have just replicated that, right? So at least I mean 40 or 50% of the 8 marks are going to be very easy, na? They have no, it has no rocket science attached to it. If you remember the accounting standard, easy marks here. But that's not the real thing that because of which I'm doing this question. It's more important for you to understand how to develop answers from an investor's perspective. So whatever we have discussed, just see how your examiner explains that. You see, you need to understand that provisions involve uncertainty. And if you are not providing disclosures, that uncertainty will pass on to your investor as well. Yeah, imagine. I'll take an example. Let's say Hasham. Hasham, are you here? Hasham, are you listening to me? Hasham, Hasham, are you listening to me? So let's say Hasham had gone somewhere outside. And when he came back, there were bruises on his hand, and there was a bruise on his face as well. And when he enters into his, house, his mother or his father starts to ask, "What happened? Why are there bruises on your hand? Why are there bruises on your face? What happened?" Nasham says, "Nothing." And he goes into his room. He says nothing and he goes into his room. Do you expect your parents to be satisfied? Oh, they'll say, "Oh, it's nothing. It's nothing," and they go, "Oh, what a good day." Do you think that is going to happen if you just say nothing? No, they are going to feel worried, right? And your answer of nothing is just going to aggravate that scenario. Yeah, your parents are going to say, why did he say nothing? Why did he say nothing? There must be something, and that is why he has some bruises on his hand, on his face. Why did he say nothing? He needs to answer us, right? So they are going to have more anxiety and they are going to get more anxious until and unless you answer their query. Likewise, just imagine you see a company's financial statements in which you have invested a lot of money. You see a certain provision, a liability on the face of their balance sheet. And by looking at that provision, you start to think, why have they created a provision? And your balance sheet on your face answers you, oh, it's nothing. Do you think as an investor you are going to get satisfied? It's just like your parents when they see bruises. It's just like an investor when it sees liability in your SOFP. Do you think your investor is just going to act like your parent at that moment in time? Because there was some uncertainty, you provided for that uncertainty, and when you do not provide a disclosure, that uncertainty which shows from the face, from the name provision, that uncertainty is going to get passed on to the investor, and that's not good for your investor. Your investor cannot decide, cannot make better decisions when they don't have information about it. So disclosure should provide important information to help users understand the nature of the obligation, the timing of outflow of major economic benefits, uncertainties about the amounts or timings involved, and a major assumptions made. The disclosure note also splits the provisions between current and non-current liabilities. You see, whenever you split your liability or your asset and you classify it properly into current and non-current, this is related to completeness. Remember, if you have studied ISB's conceptual framework, and ISB's conceptual framework is the Bible document for every accountant. Under that ISB's conceptual framework, there is a fundamental qualitative characteristic, which is faithful representation, right? And under faithful representation literally means complete, neutral, and free from error, free from any material error, right? So since you are providing information about your provision and classifying into current and non-current, basically you are complying with the completeness of information. Thus, you are actually fulfilling one of the conditions of conceptual framework, and you are faithfully representing the state of affairs to your investors, and investor will obviously be happy about it. This helps users of the financial statement, meaning your investors, assess the timing of the cash outflow. Important point is by providing current and non-current classification, investor gets knowledge about timing of the cash outflows 1 year after or more than that, the potential impact on Mehran's overall net cash inflows. It would be useful to provide further information about the expected timings of the outflows classified as a non-current liability. So here your examiner is saying that, a non-current liability is a liability which is going to occur after 1 year of the reporting date. But how much later? Is it going to be 1 year after, 2 years after, 5 years after, 10 years after? Is this the discounted value or the full value? Questions like these are still to be answered. And if some sort of narration would have been made part of the disclosure, it would have been much more faithful. It says that financial reporting focuses on past events, but provisions, disclosures also provide information about the future. Again, this is very important point. This disclosure note informs investors about restructuring activities within the stores, but also in finance and IT. Whilst this restructuring will incur cost, while we do agree that whenever a company does some restructuring, it will incur cost. But investors may value Mehran's efforts to streamline its operations and improve efficiency, right? So it's just like if you listen to if you listen from me that I'm going to invest in my infrastructure and IT, you'd be happy because you would then understand that okay, if Sir Yasir is spending a lot in IT, maybe we are going to get a much better experience the next time we take a session, right? So this will provide value to Mehran's investors. Moving forward, this disclosure shows that provisions as a total balance increased year on year. Liabilities always entail risk because there is an obligation to make payments, even if the company has insufficient liquid resources to do so. Provisions might be viewed as particularly risky because they are estimated and therefore the actual cash outflows might be significantly higher than estimated. Some investors might be deterred from investing in companies with substantial provisions. Now, this is one of the other reasons as well. Until and unless you provide a disclosure on your provisions, remember, since provisions are supposed to be uncertain, companies do not tend to invest, investors do not tend to invest in companies which have provisions, because provision ultimately is a judgment and that judgment can go wrong. And if it goes wrong substantially, your investor could be losing a lot of money rather than a lot less money. And that is where, in order to comfort your investor that nothing big is going to go wrong, you provide such type of disclosures to your investors so that your investors can see that, okay, there can be some under or over provisions, but those are not going to be so big, so material that it vastly affects your financial wealth, right? Then, with regards to refund provisions, the amount utilized in the reporting period is less than the provisions at the start of the year. This suggests that in the prior year, management had overstated the refund provisions. This may cast doubt on management's ability to accurately estimate its provisions and increase uncertainty regarding Mehran's future cash flows. Further information could be provided. Now, this is very important. Whenever you get a question on investor's perspective, I highly suggest try to make one paragraph, preferably only 2 to 3 lines on what could be done better, right? Just think about in your scenario what could be done better. Maybe we tell more details about provisions, maybe something about discounting, something more about non-current liabilities and so on and so forth. Maybe we descriptively tell what the assumptions we took. For example, we discussed that why don't we include that what are provisions as a percentage of sales, or what percentage did we assume to calculate these customer refunds, right? So further information could be provided to help users assess the adequacy of provisions made. Part of restructuring provision is classified as non-current, but no information is provided about discount rates. Very little information is provided about uncertainties that would impact the measure of provision or assumptions made. So there is no detailed disclosure on what are the assumptions that have been taken. This hinders the ability of the users to assess the adequacy of management's estimate, a generic answer, a generic point. If we provide further information about provisions, it is going to be useful. Wow. Just this. Now, some of you might think, sir, this is a very lengthy answer on such a short question, but nobody is expecting you to replicate what your Kaplan publisher has done. You see, Kaplan is a publisher who is writing an answer while sitting in air-conditioned rooms. They are not giving the persons writing this answer are not actual people who are giving their examinations. So they are basically writing an answer which is covering more points as compared to what was required, so that each and everybody's ideas could come into one answer. You see, what I'm trying to say is, Maybe if I was there in an exam and I saw this question, I might have answered this question differently as compared to how you would have approached this question, right? But when your publisher writes an answer, he wants to cater the answer of you and me both, so that you can refer to the same book and say, okay, I thought about this as well, and I can refer to this book and say, okay, I thought about this as well. So your Kaplan examination kit might try to write more points so that you and I both are accommodated in within one textbook. But as a student, while you're going through your examination, maybe you're not required to go so much detailed. Whatever comes into your mind, it can be 2 points, 3 points, 4 points, whatever. Whatever comes into your mind, just try to explain that to your examiner, and that is it. I'm 100% sure that you cannot match whatever has been written by a Kaplan as a publisher. And nobody is expecting you to match Kaplan, right? Your examiner is just asking you to do your best as a student, and he is going to provide you very good marks, uh, you know while comparing your answer with other answers only. So why do I suggest that do such type of requirements? Because if you're left with very less time in your examination, I suggest do these kind of questions, because these kind of questions have no performance parameter, so to say. Any answer that you write, as long as it has some valid points to it, is always going to be a right answer. So unlike any other examination requirement where your examiner is specifically addressing to a particular condition of IAS 12, IFRS 2, IAS 19, or IFRS 9, here your just your gut feeling and whatever you infer from the question, whatever you write is going to be a right answer. So there is going to be no deduction of your marks. So let's say, again, I'll come back to the hypothetical scenario. Let's say you have 16 marks to go and there are 15-20 minutes left in your examinations, and you have one option. Either you do an 8-mark requirement of some other question, or you do an 8-mark requirement just like this. I would suggest you do a question like this, because here there are more chances that you get the entire 8 marks, or maybe 6 or 7 marks. There are people who score 49 marks, 48 marks in this paper, and you know what they say? If only I had the opportunity to go back into my examination and just get one more mark, or 2 more marks, or 3 more marks, you know it it would be best. So when you're doing your examination, every mark counts. So if you do such type of a requirement and you gain maybe 1 or 2 or 3 extra marks as compared to the other requirement that you were supposed to do while your examination was ending up, I think you should go for any requirement which provides you more marks, because those extra 1, 2, or 3 marks are definitely going to help you. Does everybody understand what I say? Right? Sir, how do we prepare for such type of questions? Believe you me, there is nothing that you can prepare for. You're not supposed to prepare for these type of requirements. It's just that you practice a couple of questions, you understand how to answer, you work on the approach, and that is it. Whatever comes into your examination, you just try to attempt it the best you can. And I'm very sure you'll get full marks for such a requirement. Make sense? So it's not about learning anything, it's just about doing such type of questions. Is it okay, everyone?